Current trends in the labour market, including very, very low unemployment and continued elevated job ads, means that wage growth won't be slowing down anytime soon. So that solution to inflation is likely to be far away. Of course, the more important part is productivity. Now, unfortunately, when the unemployment rate is low, that's really great for a lot of people because there's more people with jobs and there's less risk of losing your job and not being able to find a replacement income. But the downside is it usually comes with less productivity growth. What that means is that although productivity is likely to stop declining soon, there may not be a very, very quick productivity growth solution for inflation. This means that the Reserve Bank will have to continue to work to bring inflation down through destroying demand, basically through encouraging households to save more and spend less, and encouraging businesses to think twice about their own spending as well. We think the Reserve Bank is likely to raise the cash rate to 4.6%. That means another cash rate increase likely in July and August. And once the cash rate hits 4.6%, we think that that will stay that way until late 2024. If households were at a widespread risk of having financial stability issues, the Reserve Bank may need to cut earlier. But when we look at the data, what we're seeing is that mortgage arrears rates are very low. Many people with home loans do have excess savings buffers, and these things will really reduce the average household's risk of coming into financial stress. In saying that, of course, there is a huge distribution among households, and so economic pain, unfortunately, will not be felt evenly across households. There are some households that are already struggling, but there are more households in the Australian economy that will be able to muddle through, meaning that the Reserve Bank will not have a strong enough reason to cut rates for that purpose. We also have to remember that inflation hurts every single person, whereas higher interest rates only temporarily create economic pain for a group of people.
So when we hear the words productivity growth, we often think about people working harder or managing their time more effectively. But the economic lens of productivity growth is much wider than that. Increasing productivity is often as a result of, say, business investment or technological innovation. The public sector can also facilitate productivity growth either through research and development grants or different tax structures. Really, it's anything that we can do that allows the average worker to increase how much output they can do at a time. For example, if you have to write something by hand, you're going to go a lot slower than if you have a computer or more equipment. So productivity growth is something that is more of a long-term struggle for an economy, and that's why we have to see so many interest rate rises in order to reduce demand, rather than using productivity directly in order to reduce inflation. Productivity is long-term, whereas customers spending less and making businesses work harder for their money is short-term, and that's why we see so much of that short-term impact as a key for reducing inflation. During COVID, lockdowns, and through 2020 and 2021, productivity growth is actually going really, really quickly. And some of that has since unwound. So what we saw was maybe an unsustainable amount of growth in productivity that's had to reverse. We also know that because of the very low unemployment rate we're seeing at the moment, the marginal worker is not going to provide us with as much productivity growth as before. So it's really like anything. If you have lots and lots and lots of options, you're much more likely to get a great fit for a workplace who's going to really increase productivity. But as those options become less and the pool of unemployed people gets smaller, that's less likely to be the case. Now, we don't want to use job losses in order to create productivity growth, but we do think that as the unemployment rate rises from the record lows that we've seen lately, we should see a little bit of productivity growth. The end of the kind of unwinding of COVID productivity growth should mean that we do have a return to positives as well. In saying that though, the 10 years before COVID had very little productivity growth of around just 1.1% on average every year. We need to see a little bit more of this in order to get inflation back in the band quickly. Again, it's not because wage growth is going up too quickly, it's because wage growth is not being offset enough by increases in productivity. We can get a pay rise above inflation if productivity is going up over time, but it's hard for wages to go above inflation when productivity is not allowing us to actually get more out of each hour of work.